Hi, I'm Asif Farouk of Finextra and I'm joined by Arun Aggarwal of Swift. How is regulation impacting post-trade and what can market participants do to make sure they comply?
Okay, yeah. No question that the industry is being hit by a tidal wave of regulations, and there's been many major directives that have been enacted, whether it's in the US or in Europe in particular. We look at things like Dodd-Frank's in the US, EMIR in Europe, CSDR, MiFID's been there for a while, and there's MiFID 2 coming as well, and there's many more. So there is a real, we say so, like a tsunami of regulations. But I think what we do feel is that for a while there was a feeling that, okay, what are we going to be hit with next? What do we do about this? And people sort of caught in the headlights, and that sort of feeling of not being able to cope or understand the regulatory change. I think that's starting to clear. So I think the fog is starting to clear. People are starting to say, okay, we get the broad outlines of what regulatory change means to the post-trade environment. Now how do we deal with it? They're starting to plot a way through. And one of the things that we see, and I think we would like people to think about is, okay, now start to think how you plot your way through, but in a much more holistic sense. People were for a long time just taking very piecemeal solutions just to deal with the next crisis. Now I think people should be and can start to think of a longer term strategic solution to all these regulatory changes. So that's one key thing, that people need to think sort of holistically, and you can now do that to a certain extent. I'm not saying all of the changes are crystal clear. But if I just pick on some of the big changes that this entails. So as a result of all these regulatory changes, the post-trade environment has to become a whole lot more efficient and a whole lot more transparent. MiFID was all about transparency. A lot of the other regulations are about risk mitigation. And of course, the underlying economic drivers mean you've got to be a lot more efficient in terms of cost efficiency. So all those things come into play. We're seeing a big push towards shortening settlement cycles. So T+2 settlement cycle. If that goes through, well, it will go through, and when it goes through, then people have to make sure that there's an old fundamental concept, any management consultancy book of right first time, right? I mean, you apply that to this industry, which has tended to be high in terms of settlement failures, breaks in the processing, etc. You've got to really go for straight through processing right first time. What does that mean? That means that you've got to get your trades confirmed and affirmed right up front, right? On immediately post-trade, on the same day, trade affirmations and confirmations electronically. So the days of emails, people picking up the phone to say, hang on, I thought we did this, you think that we did this. No, that really isn't going to work. So there is a strong drive towards electronic trade confirmation and same-day trade affirmation. So that's a big push. And it's an area that we, Swift, are playing a big role in, because that really plays to our core strength of trade confirmation, data messaging, real time. Yeah, so that's a big area for us, and we have a number of solutions that we have brought to the market. So that's one big area. And then if you go through that whole process, the post-trade process, apart from then confirmation, then at various stages you've got to match the trade. So again, you've got to make sure that both sides are truly on the same page. We will not get a settlement failure later on. You've got to go through that into trade reporting. So trade reporting is a big feature of all the new regulations as part of risk mitigation and transparency. The scope of trade reporting today is huge, right? And part of the problem is it isn't a single repository that you have to report to. So we are seeing a proliferation of trade repositories. In that environment, what's the best way, most efficient way of reporting without being caught up on, well, I need to report to this repository in this way with this protocol? One of the things that's key here is standardization of how you report. So one of the things that we're propagating is standardization of messaging and standardization of network. Again, all the core things that Swift does can be applied to this trade reporting environment. So trade reporting, that's absolutely critical. And you can take it all the way through further, and when you get into the sort of settlement side, that the demands that are being placed now on how you manage the settlement against using collateral, so collateralization of transactions is critical. All of the regulations ask for collateral, more and more collateralization. And by various estimates, there's going to be a huge shortage of good quality collateral in the marketplace. So the efficiency with which you manage collateral and how you can move collateral in a much more efficient manner is a high on the agenda. And again, that's people are looking for solutions in the collateral management space. Again, it does mean things like being able to monitor and move collateral real time, have it in a standardized manner, and really have it reported so you know what collateral you hold where. So that's a big area, and that's putting a lot of demands on the industry. And linked to that, I would say to some extent, is liquidity management. And so settlement, of course, is about two sides. One side is the cash side. On the cash side, again, there's a whole host of new demands on intraday liquidity management. And traditionally, people weren't uniformly that good at intraday liquidity management. People have tended to be good at maybe their major currencies and not their minor currencies, and they haven't been very good at all at aggregating liquidity across an organization. So, different subsidiaries managing different liquidity pools and not aggregating. All of that has to change. Otherwise, let alone just compliance, the cost of that is going to be quite a burden on organizations, especially when the trade margins, profit margins are falling dramatically. So there's really, that's just a quick sweep over the surface of some of the big changes, but they really are significant. We're seeing now, for example, anecdotally, we're seeing, for example, hedge fund managers, right? Who would have thought a few years ago that a hedge fund manager would turn up to one of our post-trade conferences and say, okay, now what does this mean after I do the trade in terms of the processing? Like previously that was another world, couldn't really care. All of a sudden we've got front office, hedge fund managers, traders turning up to post-trade conferences to work out what does this mean in terms of the full life cycle of a trade. So that I think tells you a lot in terms of the way the industry is moving.